Treasury yields extended the move lower, and right now, if we thought they were stubbornly low at 260, 250, 240, and 230, boy, they got outside the Fed's target range, south of 2.25 now in the 10-year note yield. You're looking at that 3-month 10-year inverted to levels not seen since 2007. Bells and whistles are going off. When is this going to stop? Where's the turning point happen? The data that we've seen here hasn't really been the catalyst for this move. It's been more about trade issues, ripple effects from potential fears of what could happen. Yeah, we're seeing some things happen politically over in Europe that are probably not settling, as well as weaker data. So the growth numbers in Europe may start to falter. And I think the Fed right now has been quiet. And I think that's something that isn't typical. The Fed will come out and either try and talk the markets the other way, or will suggest that everything is fine. And we do get Fed speakers from time to time talking about their patience, but I think part of that might be their patience to do nothing and sit on the sidelines. Let the market run its course. Let the demand come in. We've seen a great deal of demand for treasuries and buying, taking those yields down to the low, not only in the 10-year bucket, but across the board. And I think that right now that will continue as long as the uncertainty continues. And I think that equities right now are a very good barometer of where investor sentiment is. If we saw major breaks in some key moving averages in the equity markets, that will only feed to the demand we're seeing in treasury space. And if you look at market volatility in treasury space, it's the highest of the year. So we're seeing the MOVE index, we're seeing other readings. Yeah, everybody's on edge. We broke out of the range. When we got south of that 235 yield, things changed. There was a bit of volatility. Now all of a sudden we've got a lot of, whether it's covering of shorts, whether it is protection, whether it is a demand for yield, which is going away quickly, we are starting to see volatility bid and stay bid. If you look over in equities, the VIX index, while it is higher, certainly not on the year-to-date highs, and certainly not showing any kind of fear as equities tumble. So right now we're seeing that disconnect even more glaringly as we look at yields going lower and volatility going higher in treasury space. We see stocks plummet, and we're not really seeing that bid to volatility that we're used to seeing historically. So again, some real glaring visuals here as to how disconnected the market is and has been for quite some time. And I think if we look ahead, the trade tariffs, penalties, whatever you want to call it, with China, that isn't over yet. The politics and the economics in Europe, which are going to be a weight, I think, on the U.S., they're not going away. And the Fed is going to have to step in and at least talk about this. And we do have a June FOMC meeting with a press conference. We do have the semi-annual testimony to Congress in July coming that has not been set yet, but that'll be another chance for Chairman Powell to speak. And I think at those two events, we're going to be looking for their outlook for the second half of this year, given the backdrop of what we've seen here, given the lowest yields we've seen since 2017, given higher volatility levels than the Fed is probably comfortable with. How will they paint the picture for the second half of this year? Because the market's expecting a rate cut, but the Fed right now stands strong that they're not going to be cutting rates. And I think at this point it comes down to a balance sheet trade. How will the Fed use its quantitative tightening to possibly push yields higher? Because right now they are stubbornly low, and that yield curve going negative doesn't help with expectations moving forward. So right now, still plenty of demand and plenty of buyers out there for treasuries, but for how long? Take a look over at the equity markets. They're the ones that are going to tell you where the barometer for sentiment is, and right now it's looking very bearish there, making treasuries that much more bullish.